Chris, for that great introduction. I appreciate it. Um, like I said earlier, I'm really excited for this presentation. I've put a lot of time and energy into it. We're actually going to do a four-part series. Today, let me share my screen here. Today, we're actually going to talk about an introduction, really, to what is a fund of funds and how it can benefit you. And really it's about why. And so just to set the expectation today we're not going to go through super technical stuff. I actually had a presentation all written and everything that was like really, really technical and out in the weeds and all that kind of stuff. And I shared it with a couple people privately and got the feedback to scale it back and to start with why and what is this thing that we're doing, right? What is a fund of funds? And why is it the capital raiser's unfair advantage? um, so before we jump into this, I want to do a quick introduction of myself, and I want to just kind of set the stage. First, let me just say I prefer pretty casual presentations and casual conversations. That's my preference. But I also do a lot of like deal presentations and like more webinar style. And so I may naturally fall into that, right? And just keep going. But if somebody has a question, I would love it if you throw it in the chat or raise your hand, or you know what, just unmute and interrupt me. Totally okay. Totally okay. I will have time at the end specifically for questions, but if something's burning, like let's have a conversation, right? We're all friends here, right? So let's dive in. Okay, so first, who am I and why should you be listening to me talk about fund of funds? I'm going to keep this really, really short and high level, but I've been in real estate friends since 2009. From 2009 to 2019, I was in the single family space, did a lot of work in that. In 2019, I discovered syndications and moved into multifamily and was syndicating. Through that journey, I was a student in 7 paid mentorship groups. And then later I became a coach, and I've helped over 100 people buy their first multifamily deal. And then in 2023, I discovered this model we're going to talk about today, which is the funds of funds, which is an absolute game changer. And this has become my primary business model going since then, since 2023. So in this session, as I mentioned, we're going to talk about what it is and why it is a fund of funds. But in the future, keep in mind this is a 4-part series. So we're going to talk about how to find and vet deals. We're going to talk about the legal requirements, what you need to do a fund of funds, and at the end, the last session, I'm literally going to tell you how to launch it. 14-day checklist. You can be up and going in 2 weeks to launch one of these things. It's not that hard. A little bit of money that you got to put out and a lot of work, but you can do it in 2 weeks pretty easy. So let's dive in. So before we get really into the meat of it, though, we've got to do a disclaimer, right? You always have to have a disclaimer, right? And this is just a standard disclaimer slide, friends. But keep in mind, I'm not a lawyer, I'm not a CPA, and I'm not a financial advisor, right? So this is just for educational purposes. Please consult with your legal professionals before you make any decisions, and you're responsible for your own actions. All right, let's dive into the real reason you're here. So, what the heck is a fund of funds? So, in short, friends, basically what this is it's a way for us to pool people's capital into one entity and then invest it into another. That's the short answer. This actually has been going on for a long, long time, right? The actual original funds of funds we're going to talk about over here. This is what people are used to being called a blind pool fund. Okay. In the traditional fund of funds model, what happens is these people will define a buy box. Let's make something up real quick here just for fun. Let's say 123 Capital buys 50 to 100 unit buildings in downtown Minneapolis, right? And they're always going to be somewhere between $5 million and $10 million and return a 20% average annual return. That's a buy box. Okay. So when people invest into these blind pool funds, they're going to pre-deploy capital before the deal is found, typically. Say they give $100,000, and then that $100,000 sits there until the person finds a deal, and then they're going to go and invest in that deal, right? So the money's is there ahead of time, and this is the way it's been for a long, long time. These things have existed for decades. They have some pros, they have some cons. The biggest thing for me is I don't like that people don't get to choose the individual deal they're going into. That's my biggest flaw with it. That's what I don't like. The other piece of it is, as a capital raiser or an investor relations person, it's a problem to get people to invest multiple times, multiple tranches, right? So if somebody's going to invest $100,000 with you in these blind pool funds, they're probably going to do it once, maybe twice, right? But these other deals, they eliminate both of those problems. So the next options I'm going to talk to you about are the SPV, right? Or the special purpose vehicle or single purpose vehicle. What this is, you guys, is it's one LLC, one bank account tied to one asset. Real simple. What you're going to do with one of these is you set up this entity and you use that entity to raise capital inside of it. And then you're going to deploy that money into another operator's deal. So let's just say you found this really great syndication with $1 million minimum and amazing returns. So all you need to do is find 20 people to give you $50,000. And you pull that all into one account, and then you get to deploy that into that deal with the $1 million minimum. So what you do is you become a capital aggregator. And the SPVs, they've got a lot of really good benefits to them, right? The core philosophy is one deal and one LLC. You guys, these cost somewhere between $5,000 and $7,000 to set up, and somewhere between $1,500 and $2,500 a year to do an SPV. Now, the cool part about it, depending on the provider you use, sometimes they'll literally take that money out of the capital you raise. So you don't have to have any money out of pocket to set up an SPV. But $500 to $7,500 setup cost, and anywhere from $1,500 to $3,000 a year in management gets really expensive if you're doing multiple deals per year. That's the problem with the SPV. If it's $7,500 and you do 4 deals a year, that's $30,000 a year you're paying just in setup costs. So income, the flexible fund over here, right? Or some people call it the customizable fund. Okay. They're the same thing. They're interchangeable. What this is it's one entity right here at the top. And then inside of it, you can put multiple little LLCs or investments inside of it. So it's literally like you set this thing up one time. You pay the setup cost, which is probably roughly around $20,000, again, depending on the provider that you use. You do one set of blue sky filings. The investors have to sign a PPM one time. And now you can do, depending on how you set it up, a dozen deals inside of it, 100 deals inside of it. It's really awesome. Yes, I want to mention the best-in-class providers here. I don't have any referral relationship with them or anything like that. But the SPVs, if you want to go do some more research, TribeVest is the best-in-class provider for an SPV. The flexible fund or customizable fund, okay, there's 2 that you can look at. The first one is called A-Vestor. Great people, great product. The other one is Cash Flow Portal. Both of those people can do this flexible fund for you or customizable fund. If you want to do some more research on what those are and how they work, that'd be the place to go. So now for a visual representation of everything I just explained. So as I mentioned, the SPV, right? This one's really easy to understand. One single asset LLC that you do a syndication for to one LP investment. Pretty simple and straightforward. The flexible fund, as I mentioned, you got one entity up the top, one-time entity set up, one-time PPM set up, one-time blue sky filing fees, right? And now you can put in a passive investment in it right here. So you find a syndication, a multifamily syndication, and you're passively invest in it. Awesome. You can do that. Commercial building, right? A triple net building. Or let's see who's on this call. Let's say you want to put this stuff into some condo conversions with my buddy John here, right? You can do that right here inside this flexible fund. I've done it personally with my flexible fund into John's deals. And the best part, friends, here's the best part. This last example over here on the right, okay? If you buy your own deal, instead of setting up a syndication, instead of setting up a PPM for your own deal you're buying, what you can do is you can joint venture with your fund and your property entity LLC, right? So you can raise all the capital in your fund and then just joint venture with the LLC. Because these flexible funds, these customizable funds are an absolute game changer, a Swiss Army knife of capital raising tools. Okay. I'm gonna pause here for just a second because I think that there's probably some questions here, and we're going to move on into some different topics of why and kind of the economics. So that looks like there is one question in here. Hold on just a second. So in customizable fund, you can also do PML, private money lending. Absolutely. You can do private money lending inside of a flexible fund. So this is governed by your PPM that you set up. If your PPM says this is only a real estate fund, it's only a real estate fund, okay? But mine, I set mine up to be extremely broad, so I could put almost anything in it, all right? So let me just talk to you about some of the things I've done in my flexible fund in the last couple of years, okay? So I bought a 28-unit apartment building in Jerome, Idaho, my own deal. My fund joint ventured, right, with this. I raised capital for 240 oil wells with my friends over at Aspen Funds, and that was just an LP position. So I aggregate a whole bunch of investors' money into my bank account, and then I do an LP investment with Aspen Funds. And then Aspen Funds pays me the proceeds, the benefits. I take my spread, which we'll get into in a few minutes about how that works. I take my spread, and then I pay my investors. I did the same thing with a debt fund. So it's not directly private money lending, but somebody else is doing the private money lending, and I'm investing in them as an LP. I LP'd into John Lane's deal. Same thing, right? It's basically a debt fund. Pays a 15% cash on cash every single month. We built a bourbon distillery. I bought my own deal. I bought a triple net investment in Mountain Home, Idaho. Right? So literally you can put almost anything in here. They're amazing. Any other questions about SPVs, flexible funds? Awesome. All right, so I just covered what it is, but why should you do it? Right? Why should you have a fund, right, versus say co-GP? Well, because in conventional syndication, well, there's a lot of reasons. The first thing is you really need to protect what matters most to you, right? Which is your investor relationships. In typical co-GP situations, the lead sponsor has full access to all of your data, okay? And including your investor list. And I doubt any one of you on this call would work with somebody that you didn't trust with that data, right? And I don't blame you. That's the first thing you should say when I start talking about this. I trust this guy. Well, trust is something that is, you can still have trust and people can make mistakes. Things can go wrong. Okay. I've been on both sides of this situation. I raised capital for a multifamily deal in Tulsa, Oklahoma, way back in the beginning of my career. And I worked my tail off and I brought well over a dozen investors. They were pretty small checks. A lot of people, small checks, right? One of my first capital raises. And every single person that I brought to the deal ended up on the lead sponsor's email list. Every one of them. I trusted her. Heck, I still trust her. But it happened. On the other side, the flip side of it, I was the lead sponsor on a deal in let's say in Texas, right? San Antonio. Some people will figure out which deal it is if I'm not careful. I was the lead sponsor, and we did webinars, and I was the person with the webinar software and all that stuff. So all these leads were in here, and my assistant imported the wrong list into my CRM. And so every single person that registered for the webinar, regardless of who referred them, ended up in my CRM. I didn't know that it even happened for like 2 or 3 months. And finally, so I had like 2 different people on the team say, Senate, are you emailing my people? And I'm like, no, I don't think so. It took weeks to clean up, friends. It was an absolute disaster. So yeah, it can happen. Next, build institutional buying power. We're going to really dive into the specifics of this in a minute. We're going to spend a lot of time on this, but in short, friends, if you invest $50,000 with somebody, they're going to give you one share class, right? But if you invest $1 million, they're going to give you a different share class. And you really are building this institutional buying power. Next, we talked a lot about concentration risk already, but you didn't realize it, right? Here, I have this strong opinion. If you're the operator, if you're running a traditional syndication, if your name is on the line for the actual operations of the deal, my opinion is you need to be an expert in that asset class and in that product. You guys, I'm a multifamily expert. I'm very proud to stand here and tell you that. But there's no way I could be an expert in all of these other things that I've done, right? Mobile home parks, condo conversions, oil wells, bourbon distilleries, debt funds. There's no way. But I'm now able to focus on vetting operators, and I can bring out multiple different types of assets to my people, to my investors, right? So I can build this institutional platform of investments, not just be the multifamily guy, which, you know what? I'm not dissing that. If you want to be the multifamily guy, that's okay, right? You can still use this and do that. I just think that people need diversification, right? Tony Robbins wrote a whole book called The Holy Grail of Investing, and it's about diversification, right? Anyway, last thing, compliance. I'm going to spend a minute here. There's a lot of people that have broken the law and not realized it. Probably some people on this call could go to prison. I'm not kidding. Not a fine, not your hand slapped. We're talking orange suits because they didn't do this compliantly, right? The co-GP model, friends, is broken. The time when you can go and buy a deal that needs a $10 million capital raise and go get 10 co-GPs to come in and raise capital for you, that time is over, right? The SEC, FINRA, the DOJ, they're watching this stuff. And if you're not compliant, they're gonna come find you, right? So when you set up your own fund and you have a fund of funds, you now become the issuer, which if you understand the SEC rules, right, being the issuer now the rules change for you, right? You have a lot more flexibility, you have a lot more freedom, and you now have a lot more responsibility than just raising capital, right? You're sourcing deals, you're vetting operators, you're vetting deals, you're doing compliance, you're doing checklists, you're doing accounting, you're doing investor relations. It's super easy for you to prove to a judge that you are following the rules. But if you're a co-GP and you go and raise a bunch of money and you just sit on the asset management call once a month, it's pretty hard to prove to a judge that you had another job. I think, you guys, this is probably the biggest reason that a capital raiser should use a fund of funds model. Stay out of jail. Okay. All right. I'll stop that. Any questions so far? Feel free to drop them in the chat. I'm going to move on to the economics, right? How do you get paid? Well, in short, is a fund of funds, you get to buy wholesale and sell retail. That's really what it comes down to. Okay. The common misconception out there is these fund managers are just lowering the returns investors get because they add more fees. You guys, sometimes fund managers have fees. Sometimes fund managers take a spread. There's a lot of different ways that you can make money. And depending on the way the deal is set up. But what really matters to me personally is when my investors invest with me, their returns are equal to or greater than what they would have gotten if they went directly to the sponsor. So let me just tell you a quick story about a deal that I'm raising for right now. Okay, it's a debt fund. It pays my investors. Anybody on this call could invest in this deal and get 16% cash on cash paid to you every single month. Well, that's the same as if you went directly to the people, okay? But they've got a pretty good size minimum, right? So what I did is I went there and I said, I'm going to bring you $1 million. And I negotiated that they're going to pay me 19%. So I get to keep the 3% spread. I pay my investors 16, they pay me 19, I keep 3. Pretty simple. Not every deal is that simple and clean. I'll show you a couple examples in a minute. I found a question. Just a second. You just mentioned fund of funds is better for compliance, but then you favor flexible fund to invest. I guess there's some additional clarification missing, or I might have misunderstood. Let's go back to this slide. You guys, the SPV and flexible fund, from a compliance perspective, in my opinion, for this conversation at least, there's no difference. You become the issuer. You still have to vet the deals. You still have to find the deals. You still have to have all the responsibility. You still have to do all the accounting. You still have to do all the investor reporting. Literally, the only difference is in SPV is one project, one LLC. The flexible fund, one LLC, multiple projects. You still have to follow the rules, PPM, compliance on every individual deal. It's just a lot easier to streamline this and to save money. It saves headache, saves money. It's just easier and faster. Great question. Some real good questions coming in. I love this. All right. We talked about wholesale terms. Really, you guys, this is the Costco analogy. Okay. If you go to pick a store, Fred Meyer, Albertsons, Winco, whatever you have in your area, HEB if you're in Texas, right? And let's say you buy a candy bar, a Snickers bar, right? And the Snickers bar costs you $2. I made it up. I can't remember last time I bought a Snickers bar, right? If somebody knows the cost of a Snickers bar, put it in there for me. So it costs you $2 to buy one Snickers bar. But you can go to Costco and you can buy a whole case of Snickers bars, and now they cost you $1 a piece. So you just saved a whole bunch of money, right? But now what if you take that box of Snickers and you go and walk around the street or walk around a fair or walk around the mall or walk around somewhere and sell them for $1.50? Well, Costco's happy because Costco made some money, right? The end buyer's happy because they just saved 50 cents on a Snickers bar, and you're happy because you just made 50 cents. Now you did that times a case. That's exactly what we're doing here, friends. The only people that aren't happy are Winco and Albertsons, right? Because they charge more for the same product. With Eric, you know what? It was my first business model too, Chris. We have a store here called Winco, and they have candy that you buy in bulk. Literally, it's just like scooper. You scoop in and fill up a bag of candy. And I took that exact bag of candy, bought them for a penny, 2 pennies, whatever, and went to the store or went to school and sold them for $0.25 a piece. Awesome. All right, so let's get a little bit more specific here. You guys, we're almost done. We only got 4 more slides left. So let's do another example, a more like multifamily-ish example, so that we can come up, hopefully generate some more questions here. Okay. So this is the Harry and Sally playbook. Literally, I made this up, friends, with the help of AI, and so if there's something in here that doesn't mesh, it's not a true case study. Okay. All right. So, Harry, right, the operator, his standard deal terms are a 6% preferred return and an 80-20 split. My suspicion is if you brought him $50,000 or $100,000, that's what this person's going to give to you, right, as an investment. Not bad. Pretty good deal, right? Well, Sally, she's a fund manager. She goes and talks to Harry and says, Harry, if I bring you $1 million, instead of a 6 pref, will you give me 8? And instead of an 80-20 pref, will you give me a 90-10 or 80-20 split? Will you give me a 90-10 split? And Harry's super happy because now he gets $1 million in one check, right? Instead of having 20 investors at 50, he gets one at a million. And he's like super happy. And Sally has significantly better returns, but she can't give those same returns to her investors. She's got to make money. So she gives 7% preferred return and an 85-15 split to her investors. Her investors are happy because it's better than what Harry was going to pay, right? Sally's more generous than Harry. That's their thought. But in reality, she just negotiated a better deal. And now Sally gets to keep the difference between what she negotiated and what she pays her investors. So in this case, it's 1% on the preferred return delta and 5% on the profit splits. And this says it's a 6% total spread. This is wrong. I'm realizing as I say this is wrong. Okay. Because the preferred return, really, you only get the 1% if it's current, if they're actually current paying. And it'd be 1% per year. So if it's a 5-year deal, you get 1% for 5 years. So now you got 5 plus the split on the back end. And then the profit split, 5% could turn into a lot more than 5% on the capital you raised. Okay. So I do need to work on this slide. I apologize, but it gives you a pretty good understanding of basically how it works. This next slide, this is a legitimate actual 3% spread. This is, I should have saved the story about me raising capital and 16 and 19% until right now. So bring it up here. My case study, I pay my investors 16%. The deal pays me 19%. I get to keep 3%. Okay. 3% per year. His friends, 3% per year doesn't sound like a lot of money. And maybe it isn't to you, right? If you raise only $50,000, it's $1,500 a year you're going to make, or $7,500 if the money's in there for 5 years. Okay. But what if you raise 500,000? Now that's $15,000 a year. that you're going to make. I like round numbers. $100,000 or $1 million raise turns into $30,000 a year. Can anybody live on $30,000 a year? Not very comfortably. Plus, there's some expenses and some costs. Why would you do this? What if you do it 10 times? Now you're making $300,000 a year. Do it 20 times. What if you did one a month for 3 years? You raise $1 million a month for 3 years in this exact model, and you get 3% spread. I didn't do the math, right? But it's somewhere around $1 million a year, roughly in my head. Pretty cool, right? Scale. That's what we're building. Long-term institutional wealth for your investors and for you. That's the why. What questions do you guys have? I mean, I'm literally like, I feel like I was expecting more questions, right? So I threw a lot at you.
So the one thing, sorry,
Go. Yeah.
the one thing I was trying to type it into the comments and then couldn't. Um, the one thing that I see on the fund of fund model that I love is the recurring of that profit annually. I mean, conceivably, if you've got a good investment, your, your airline deal, the flight school, like that's 3%, let's say $1 million raised, that's $30,000 for a decade, right? And you're really, I mean, your analogy of uh raising dollars, people 50 grand each, that would be 3 months. So you divide the 3 months into a 30, I mean, $30,000.
I think we lost John there. But I believe what John was saying was one of the things he likes about this fund of fund model is the reoccurring annual income. You can really build this a lot of ways. In short, what you're going to do is you're going to get a spread of whatever the profit that your investors are going to receive, right? And so in a purely debt fund scenario where they're paying out every single month and cash flows coming into you every single month, John's absolutely right. You get annual, monthly, reoccurring income every single month to you. Well, I told you I built this bourbon distillery, right? Well, this one pays out totally different, friends. Like the first 2 years, there's basically zero cash flow. Huge tax advantages, though, but zero cash flow. But then at the end, it's like 8 times your money, right? So for me, that deal, I don't make any money really during the hold period. I make a little teeny tiny bit up front. I take a due diligence fee, but on the end, when it closes, when it exits, I'm basically going to make whatever I raised. So if I raise $1 million in 5 years, I'm going to keep $1 million. My investors get 7 times their money. They're going to get 7 million back, and they pay me $1 million to do it. Do you think they're happy about that? Yeah. So my point is, this example I have on the screen is only if it's like a monthly cash flowing debt fund. I thought about how to build out a slide for things that pay later, but in short, I just take a percentage of whatever the profit is, and it's not a set percentage. what I do is I say, what do the investors need? How is this a good number for my investors? And I keep the difference. So sometimes it's 3% a year, sometimes it's 4, sometimes it's 5, sometimes it's 2. Always take care of your investors first, and you'll win.
Senate, I'm going
Um,
to pop in here. We've got some questions.
yeah.
First, Philip put in the a question in the chat, and then we'll get to Kendall. First of all, with Phillips, I think it's a good one to think about in the lens of that bourbon deal.
Mhm.
Let's say someone wants to raise capital for that bourbon distillery deal. Investors are going to have a bunch of questions with that. So,
Yeah.
how do you make sure that they get their investors or prospects questions answered, and with the delay with the K1s, just like Philip wants to know?
Yeah, great questions there. So next week, we're going to talk about due diligence and deal vetting, and basically how you become knowledgeable enough to be able to sell these deals. Okay. But in short, if you're bringing an operator $1 million check or a $500,000 check, if you're new, or even 250, right? They're usually a lot more open with the information. And they're a lot of times they're really willing to help you, right? So I actually ask my lead sponsors, I ask so much of them. I get their pitch deck, I get their landing page, I get their email templates, I get their text message templates. I basically get all of their marketing materials, their FAQs, their pages, right? And I have an assistant. I give all this to my assistant, and they repackage it all for me and send it out. And I would say about 50% of the time, I'm not even the one selling the deal. I do a webinar, I schedule the webinar, I come on, I introduce myself, and I introduce the sponsor. This is what I did with John Lane. When I raised with John Lane, he sold the deal to my people. He was there for questions. He was there for FAQs, right? And not every time do you get to do that, but depends on the sponsor. So, Philip, I hope that answered your question about how to get the information, and we'll get more into that next week.
Perfect. Thanks, Senate.
You're welcome. What about the delay in the K1s? This is the worst part of this business.
Hey, Senate, you have a hand up for Kendall.
Oh, cool. Thank you, Carrie. Kendall will come to you next. Um, in the SPV model, you issue your K1 as soon as you get it from the sponsor, right? So where you keep beating up on John here, but if you have an SPV and John doesn't get you the K1 by March 15th, he doesn't get it till April 15th. Now you've got to take at least a week, maybe 2 weeks to do your taxes on an SPV, right? So now you're not delivering it till May 1st, and your people are annoyed. With the flexible fund, it's even worse because you have got to get all of your K1s for every deal you've done before you can file your taxes. But I have a workaround. Okay. Just discovered this. So I'm in this problem right now. There's a couple of my investors on this call. They're like, yeah, I'm waiting on my K1 from Senate right now. Right. And the reason is because of exactly what I said. I have this flexible fund, and I can't file my taxes until I get the K1 from all of my people. And I'm still waiting on 2 K1s. But what my accountant has figured out to do is we can do a draft K1 as long as we have all the K1s for the investments that the investors are in. So I have John's K1. I can send out in K1s to everybody that's in John's deal, but I can't send it to anybody that's in the bourbon deal yet, or the paving deal yet, right? Because I'm still waiting on those documents. So I hope that answered that question. John has a question, but then Kendall has his hands up. So let's go Kendall first. Go ahead, Kendall.
So I was going to ask, like, how do you protect yourself when you're doing a fund of fund of, let's say they get sued and they don't try to wrap you into that lawsuit being the person that's running that fund of fund, even though you're not directly in the fund.
If who gets sued?
If the fund gets sued. So, for example, let's say they get sued for, let's say it's not performing or something happened, or let's say I'll just use apartment. That's what we syndicate apartments, and the deal goes upside down, and they end up in a lawsuit, but then they try to wrap everybody that has something to do with it in it. How do you protect yourself from not being wrapped and pulled into that lawsuit too? So then they won't try to come after your assets.
Got it. Good question. Um, so I want to make sure I'm answering this the proper way. So I'm going to parrot your question back to you. So let's just pick a big company that everybody's going to know. So Rise 48, right? They accept LP investor checks. Okay. So if you're saying if we invest into a Rise 48 deal and Rise 48 gets sued, how do I protect myself? Is that what you're asking?
Yeah, or they get sued from the
Yeah.
that just that deal. So it's not
Yeah.
the
Yeah. Yeah.
company itself, but just that deal. But you did a
Sure.
fund to fund and you invested in it too, and your investor money is in it.
So you're going to love this. This is why it's better than being a co-GP. You're just a limited partner. So Kendall, you do syndications, you said just a minute ago. If you have 10 LPs in a deal and that deal gets sued, what happens to the LPs?
They end up on a lawsuit too, but they're like a debt, like mortgage. They are part of the mortgage too.
That's exactly it. We're passive investors, we're OPs. So they're not going to come after us, right? And if they do, we invested through an LLC. And actually, technically, that LLC, I'm not a member of that LLC. I have a management entity that is a member of that LLC, and I'm a member of the management entity. So literally, there's like 3 layers before they could ever get to me personally or my investors. And I buy a lot of insurance. So I hope that answered that question.
Yes, it did. Thank you.
You're very welcome. Happy to help. John, he sent it. If I plan to raise $1 million a year, oh, so John's question is, if he raises $1 million a year, how much money is he going to make? You know what, guys? It's impossible for me to estimate that. And the reason is because it depends on the profitability of the deal and how generous you are. Let's go back to this example here. Okay. So Sally in this scenario, right? This says she's going to make 6%. We discussed it's going to be more. But what if she was super generous and gave more away, right? Here's the number that I want to make. Okay. And that's why this next slide is built this way. I want to make 3% per year on all the capital I've raised. That's my goal. Okay. Literally I took that, you guys, from the financial advising world. That's about what the average financial advisor makes. It's 3% on the capital they have under management. So I don't build it. I don't build my deals that way. Like I said, I figure out how profitable this deal is for the investor, and I take as much and I take more, or I take the whatever's left over, right? So in this example, I told you about this debt fund that I'm raising capital for. 16% is the fair number to investors, in my opinion. But if they only paid me 18, I'd keep 2. And once I cross the $3 million mark, they're going to pay me 20. I'm not going to give my investors anymore. I'm going to keep the 4 because I worked my tail off to get up to that point. Okay, awesome. John, I hope that answers your questions. What are the startup costs to develop a fund-to-fund business? Great question. So let's go back to the SPV slide. I went too far. Here we go. I am struggling. Sorry, friends. This slide, okay? A special purpose vehicle, this part right here, if you go this route, you're about $7,000 setup cost to do one of these, okay? So, if you're going to do 3 a year, that's $21,000 a year just to set one of these up, okay? The flexible fund or the customizable fund, you're about $20,000 one time. And then there's a monthly fee, depending on the provider you use, somewhere between $500 a month and $750 a month. Or I have the wrong plan and I pay $1,500 a month, right? So there's a monthly fee as well. But then on top of that, you guys, there's like a CRM. You got to have some kind of a CRM, which could be $20 a month, could be $100 a month. Personally, for me, I also have some assistants that I pay, right? Because there's a lot of things that this job requires in the marketing world that I'm not good at. I didn't make these slides. You don't want Senate making slides, right? I paid somebody to make these slides. So my cost just to run my business with my assistants, my marketing, the AI tool I bought, this ClickUp that I pay for and all this other stuff, my cost is probably about $4,000 a month. Just cost to keep this business afloat. So if we did the 3% annually, you're not going to make any money until you've raised at least 2 million, 2.5 million, maybe 3. Like real money. Can you do it cheaper than I'm doing it and make a little bit of money? Yeah. Yes, but this is a long-term business. This isn't a get-rich-quick scheme. If you want to talk about those, I got a couple that we could talk about, but that's not what this is. This is for somebody that wants to build an institutional investing platform and be a professional and make money over the long term. Great question, John. All right, you guys, let's summarize all of this. Let's wrap it up. Key takeaways here. This is not just a business model, right? A fund of funds is here to help you build a long-lasting relationship with your investors and build scalable income through professional management. We're talking about becoming an institutional investment manager. That's what we're talking about here, okay? Your network's probably one of the most important things. Your greatest asset, right, is your people. You've got to protect it. You've got to create scale that lasts over the long term and builds trust. And you've got to stay compliant. It's not on here, but I want to hit that again, right? I don't look good in orange jumpsuits. John, I don't think you'd look good in an orange jumpsuit either. Chris might. I think Chris would look good in an orange jumpsuit. But let's stay out of jail. All right, friends. So next week, next week, we're going to talk about advanced deal vetting, right? What do you need to look for? And how do you make sure that you're bringing out good deals for people? The next one after that, I believe, is legal and compliance. So it's going to be pretty technical. We're going to talk about laws and rules and weird stuff, right, that you need to know. And then the last one's going to be how to launch, how to get one of these going. 2 weeks, man. That's all you need. You could have one of these done by the second week of August. And I'm going to tell you exactly what you got to do it. So that's what I have for you, friends. 10 minutes early, but I'm here. If you guys have any questions, we can talk about this or anything else.
Awesome work, Senate. Thank you so much. Yes, we will stick around for questions. I would like to add that as a performance psychologist who's helped people with fund-to-fund stuff, Senate hit it on the head. This is a business where you build long-term relationships. So think about this. If you love going to conferences, if you love talking real estate, if that's not going to go away, this is the business for you. But if this is something where you're like, hey, I want to just dabble and then figure it out, make my money and leave, probably not the business for you because you want to make long-term relationships. That's where you really go. So with that said, who's got questions for Senate? Give it to him. This guy has done it all and he wants to help you.
This is really good, Senate. I appreciate the willingness to share your knowledge. I guess I put that question in the chat, but uh my biggest issue is once I'm past my local network of investors, like I've got a small group of investors, how do I grow past that? Are you going to talk about the marketing? Are you going to talk about the process of building relationships over time? Like help me understand kind of where are we going in the next 3 additional weeks?
Yeah. The short answer to that, John, is no.
No.
I am not intending to cover marketing in this session. It's really about like what is a fund of funds, how do you start one, and why do you start one, and what do you need to know to start one. These are the 4 sessions I have right now, right? This one that we just did, the ultimate capital cheat code,
Okay.
and then advanced deal vetting, relief valves and communication protocols, how to stay out of jail. That's what this one is. And then the financial engineering, we're going to talk about a little bit more how to make money, what technology you need, and how to get it started. So we'll talk about like CRMs. We'll talk about which platform I recommend. We'll talk about some of that kind of stuff. Now, that said, John, I'm not opposed to doing more sessions and growing this. If this is popular and people like it, I'm happy to keep going and do more.
Cool. Thank you very much. I appreciate it.
Senate, I want to point out for Mel, who has a great question. Senate, you mentioned covering your back through purchasing insurance. How much is enough?
You know, I had this great conversation with an insurance agent one time, and we were talking about the difference between full coverage auto insurance and regular just liability only insurance, right? And he said he has got 2 different customers, okay, that he deals with. He's got one customer over here that buys the cheapest insurance he can, or the liability only, and he says, I just bought a $100,000 pickup. I made that up. I don't know what a pickup costs. If you know, put it in the chat. I just bought a $100,000 pickup truck. I can't afford the cost difference on the insurance, right? So I have to have the cheapest insurance I can. And then he has this other customer over here that says, man, I got this $100,000 truck. I can't afford to replace it. I can't afford not to have full coverage insurance. So really it's up to you, right? But here's what I would do. I would figure out what your net worth is. Whatever that is, million, 5 million, 10 million. And I would buy at least that much insurance, if not double it. Just my opinion. Again, I'm not an insurance agent. I let all those licenses go a long time ago. That is not a recommendation. That's what I would do. And in this regard, you need a couple different kinds of insurance. You need errors and emissions insurance, and you need a business umbrella insurance policy for business liability. Okay. And on top of that, this is out of scope of this, right? But if you own a home and a car and you do not have a personal umbrella policy, that's the first purchase you should make when you hang up with this call, right? Go get they're like $100 a year and they'll give you $1 million of coverage. It is so insane. Everyone should have a personal umbrella, the maximum you can buy from your agent, from your company. They're cheap. Great question.
Senator, I have a follow-up question to that. Typically, when we try to promote our own private equity deals in an LP GP structure, we kind of deal with the objection of, hey, why don't I just invest with my mutual fund manager or my wealth advisor? And we often say, hey, look, how are their interests aligned with yours as a fund manager? Because they're really just churning over stocks and trying to achieve a certain rate of return, which they can't really guarantee you. So why don't you put your money with me where I am an active investor? I'm aligned with you because I don't get paid until you get paid first. And, you've got some skin in the game, so to speak, right? So now that I'm on the flip side and I'm actually a fund manager, how do you address that objection? Like, hey, I'm a fund manager, almost like your wealth advisor is, and all I'm doing is looking out for opportunities where I can plug the money in and out of. So how would you address that? Because I've been on this side of the fence saying, hey, we're better than mutual fund managers or wealth advisors. We've got skin in the game, and I'm more aligned with you than your wealth advisor.
So I love that. And I could spend 10 minutes talking about this exact thing. So the first thing is you get to set up your deal, your investment, your sub-investment, however you want, right? So if you want to give a preferred return that puts you in that same position where you don't make any money unless they do, you can do that, right? If you run the math and it's still that business model works for you, do it. Personally, for me, I just take an X percentage of all the cash flows, right? That come in because it's simple and it's easy. Okay. But what I tell people is, so first of all, almost every deal is going to have my own money in this right alongside of you. Okay. Also, the more money you make, the more money I'm going to make because I only get paid based on your profits and your cash flows. Right. So if I put your money into a deal that sucks, neither one of us are going to get paid. Okay. I've raised capital now 51 times on 51 different deals, and I've had 2 complete losses. And I lost more money than any single one of my investors. And more reputation and more damage and more everything. And you guys, I'm not proud of the fact that I've lost 2, but I am proud of the fact that I've only lost 2 out of 51. Right? And so I only make money when you make money. That's the first thing. But let me give you one more thing to help with that. Get money out of the stock market. Maybe this will help you with what you're doing now, right? I just told you a second ago, right, that Tony Robbins wrote a book called The Holy Grail of Investing, and it's all about diversification. It's actually based on a quote from Ray Dalio, which is one of the largest hedge fund managers in the world. His quote is that the holy grail of investing is to have 10 to 12 truly uncorrelated investments, not diversified. He doesn't use that word. He uses uncorrelated, okay? Because correlation is the #1 risk to stock market investments. You guys, I was a financial advisor for 10 years. I lived this world. Most financial advisors are just glorified salesmen. They have no idea what I'm about to tell you. If you look at the SPY, the S&P 500, okay, this is the 500 largest stocks in the world. Okay, that's what it is, basically. I'm sorry, or in America, not the world. I misspoke, in America. Okay. And Google, their parent company, Alphabet, is something like 10% of the entire 500 stocks. Just think about that for a minute. What does that mean? If you put $100,000 in straight SPY, the S&P 500, you're now exposed. 10% of that investment is exposed just in Google. Is that diversification? No, I don't think so. Do the math here. Simple, straight math. 10% of that fund is Google. What if Google has a horrible earnings and drops 30% in one day? Well, just the math says the S&P has to drop 3%. But that's not what happens. Google drops 30%, Amazon's going to drop 20%. Nvidia is going to drop 15%, right? Just because Google dropped 2, right? So now the S&P 500, it's not probably not going to drop 30, but it's going to drop at least 20. That's correlation. And it is the number one risk to the average common investor, in my opinion. Okay. So here's what we do to combat that. Let's get your money into something that's completely uncorrelated from the stock market and lower your correlation risk, right? Let's just take a section of your money. You got $1 million in the stock market. Let's put 50,000 over here in John Lane's condo conversion. It's a real estate play. Let's put another 50,000 over here in a Senate's debt fund that pays 16% cash on cash, right? Oh, and you know what? There's a bourbon deal, right? It's not, again, third deal that's not even remotely correlated to what we're doing. See, we're building truly institutional investments for these people. We're not pigeonholing them into one thing.
Now, that's a good answer from somebody who has sat on both sides of that table, which is really wise. Thank you for that, Senate. Thank you for the question, Mel. That was awesome. Awesome.
Great question.
Anybody else got a question for Senate? Yeah. Right on, Casey. Pearls. Love that. All right, guys. So next week, we're going to meet at this exact same time. In the middle, we're going to clean up this replay and send it out to you guys to make sure that you have everything that you have or have everything that you need, excuse me. And then we're going to do things a little different where we're going to give you the transcript of it because we heard that some people are using their AI tools to figure out the cheat codes of the ultimate cheat code. So we'll send that out to you, and then we will see you next week. If you have anything in the middle that you have questions, get a hold of Senate, get a hold of me. You'll have our contacts in the email, and we will see you next week. Thank you, everybody.